He's wondering this too.
Sounds cool. That's why I need like a soundboard on the side where I can just press some buttons and I'll get some lyrics. So let's repeat what I was saying over the loud ass music. One was previous week I had a lot going on. I didn't get a chance to trade too much. So it's basically told you this for a couple weeks ago. We need somebody that's and just get heavy. No concerns of mine though. So we're going to do 20 minutes whatever counterpart to break. Outside of that, outside of that, you guys watching me put up the indicators for the day. AGAE there, some type of crypto investment, getting into that strategic type of investment idea. And they have some type of purchase agreement with the 6 boroughs out there. Just to keep it MQ3. They had about 3 4 days ago made letting know that they are now in crypto space, basically investment funds as well. BSTD, Atmos, CW, CWB, basically a few days ago, those results from the 7th Gen T cell injury program. So, Gauge, engage. So this is resolved. This is something that currently connect is so I look for the leading games for the day, which other stocks are basically showing the largest percent change overnight. With that, make sure that they have a low float, which is shares, low outstanding shares of the company offers for the public to invest and purchase. And make sure that number is below 20 million and that the volume is massive. So 13 million shares and the company has 1.63 million shares. The company's been bought about 12, almost 13 times. 11, 12, 13 times. So after we find those, then we want to make sure that the price of the stock is above pre-market levels. This orange area here is pre-market from 3 a.m. to about 8:29 a.m. Central Standard Time. The price breaks above there. This is where we actually look to engage the actual momentum and observe. So no one has done it so far since she broke out while I was getting ready. So right now we are trying to see if it makes any high bounce off of in the area of the market levels and then try to resume its movement to continue going higher. Where will that be higher than? So that's where you look to get in and you catch a trade that is already broke out above the market levels. You want to see will that ticker continue making it high because it's easier to make money when something is breaking out of a previous resistance level. Earlier, you guys watched me put these marks of the current ticker. This is market structure. We look to see where in the past the price has went and found resistance. So on the 4 hour chart or 1 day chart, whichever one you prefer, just look at highs and support levels that are above the price level to see if the price actually run into some type of challenge. We set that as maybe your potential target area. Today, it's 260 every dollar.
Whoops.
So right now we're trying to see if what we currently are, if they attempt to test that again, take a look at from around. So we see this little key, this little skin line, click see it. As you can see, pre-market actually shot up there to the level of 156. Try to spread from here to these two areas. So we want to see can they test that level again. They're still above this pre-market high, where the market might close down. So we are simply gaining this movement. We want to see can they take out the entire movement to here around. Okay, so we, and this is why we're going to need to see the price action test pre-market levels, because as you see the sell-off that's magnified and intensified. $14 now, here it's $8. Don't just jump into something that's anxious to get into the trade. Just be patient and to plan and see if there's something else that is supporting. As well, all of this is going on, there may be something else that will come without the leading game of the day. Because this news, has been sitting since 34 or 5 this morning. News that comes out at 9 p.m. causes the attention that we see in these tickers to dissipate and go elsewhere. So, in the meantime and in between time, we got our eyes on this AGA. Right, as you can see. And as well, when you start seeing stuff go above market levels, it's good to watch them because those are tickers that could potentially become leading edge. They're already making this top. So, game is important. So, right now, we're testing this. So, the moving average that something days of close record of currency numbers between $1 treasury discussions and show you how it works. Like I said, this is one of some 60%, 50%. This is runs. So a lot of things that I do for you guys just be for
Troopers.
examples. Shit.
It's my fault for buying those over about areas, but you ain't gonna hold that against me. Not today, people.
Shares on pop.
The popcorn watching this action.
Shares on pop.
Oh,
Hold down. Set to the side. This is what you want to be able to grow your
Go, go,
accounts to
go,
be able to
go,
do.
go,
So
go.
10-cent run, this really is like your niche. It's your bread and butter.
Okay. Y'all close the door. Keep this hand so y'all stay up there.
10-cent pot, 20-cent pot, taking proceeds on the ingredient. Typically, change seems like $1
What
pot,
y'all gonna do?
80 cents, 67 cent pot for trades. Because I really that at all. It's a small, quick things that you want to capitalize on. You have to make commission times. 1,000 sheets, so you see 7 to 6 cents. So that's what you want to get out close to the counter and trade. Because we are live trading, this will cause me to take extra trades just to show you practice and theory how it works. This is what else I'm saying. So high above this line, just everything in it. At some point, the price is going to come back down. It's not this thing called mean virtue. They want to come back to the average price, which is try that
Beverage.
is
Beverage.
so you catch you one to what you can. Stay in the trades, run, stay alone.
Y'all get all that fight and get back up.
Needs people. So the price shot up so high, they wanted to come all the
Y'all
way
don't
up
pick this shit
it's
up.
bouncing up, take a position just to see if this potential pop is going to be sustained in that bounce, but I don't see things for this. So that's where people track it such there's no catalyst explaining why the stock is moving this way. This is just some inside trading going on, looking in individuals that know what's going on as well. But this is just a people trying to take advantage of others, but people take some purchase as much as they can to cause attention to the stock and sales off. So taking 56 million shares, 2,000 shares, to $4 million. So it's 12,000. It's just like it's billions of dollars. I don't need mom is where I guess. So, conscious, so we already had one, two, three, I think it's already on our list. So we are everything is on the represents
This is HE 214.
so it's also showing
TJ Nation Pacific Resolutions.
meeting names.
Cheat.
That's important as well to set buy stops. Just
You want
purchase
to
off
ball.
well prices do up.
Excuse me. What you about to do?
TJ.
Don't never sleep on me. Don't never go to sleep on me.
This is what it is. Shrugs shoes and individuals out. So $55 to the salary. $55, $45 for shit. So that's what this is. Right there. $45, $45 $3 a salary. This is what you watch. 72 million shares outstanding. So it's crazy.
Tight motherfucker.
It's just tracing. So it's what those ones. So proper midday numbers. Just one minute. It's very so this will say 7% average funds. That's $35 million. Just going to take optimize it. So compare 35 million to trade so trying to get out now. I just didn't really want to. I certain things, which could
136.
be
I was gonna be what?
a bad thing because the person can break through higher than what they want,
Full flag here.
and potentially take some proceeds. But more they convert to it. Watching it jump from 95 cents to 70 cents to 60 cents. If you want shit, just go right back into it. Nothing that really something that this ladder has more than two. Open your and change the pressure. Trying to power crack the other. So it takes those to the left. Please do the shit. So it up, turn it up, down.
I bought. How the fuck did that happen? Shoot, yeah, did not intend to do that at all. I was not supposed to. Okay. Just wasted 40 bucks. That's not me, no money. Oh, fuck it. What you call those? Hotkeys. So I can trade by just pressing certain keys on the keyboard if I want. But I don't do that. I just use the mouse because it's easier. See if this works out. This position was never supposed to be open to begin with, so average is 46.52. This was not supposed to be a position for sitting. Fuck y'all. Just confirm this shit. Okay, that's your business. Texting me about confirming with somebody else about doing something for their ass. Y'all don't leave the fuck alone before I cry over curse y'all the fuck out. Grown ass motherfucker man. Don't be texting me about no motherfucking shit for nobody else. Yeah, if you gonna do this shit, then go ahead and do the shit. So other than that, y'all shut the fuck up. I got shit going on right now. You think about replying to no messages or taking nobody to school. If I told your ass I was gonna do it, then what the fuck you confirming for? Let's see, no that. Whatever. was sponsored by Cutwater. It wasn't sponsored by them, but shit. If I can get some sponsorship, I'ma take them. Y'all email me with some business contacts, some proposals. Let me know what I need in this motherfucker. Some samples, a nice little setup or something, and we running. I can leave my motherfucking day job. Like I said, y'all will see me stream like once a week because this is the only day that I'm home throughout the week to actually sit in front of the camera and do this. Other than that, y'all can find me on my social media, Instagram, Facebook, TikTok, Twitter, whatever the hell. bakerdeshun, and then it'll be a recap. But throughout the week, on a Friday, we get a live trading session. So today we just trading on the notion that purchasing stock above pre-market highs, you'll get a good potential of a push of a continuation in favor of your direction to the bullish side as momentum has already been carried in pre-market for whatever news catalyst has been reported, market segmentation type of momentum that may be pushing the market higher as well in that specific sector or stock in general, security, whatever you want to call it. So don't buy anything that's not above pre-market highs. It's the biggest takeaway you can purchase. You can take away from this trade or this live trading session. This morning I opened a position that was very close. This one as well because this wasn't supposed to be opened anyway. And this is working counterintuitive to what we were trying to do today. That position was opened by accident. I was trying to find the keys to automatically open a position um, with the keyboard. And I have my hotkey set to open at a market order if you press Shift B, which may be the um, default keys to open a market order anyway. But that position wasn't supposed to be open. He was just trying to add it to the watch list. But what we're watching right now is this BCIG. Whatever the news is, it's not significant. It's moving 25% though. So we're hoping that bulls push this thing a little bit higher and this potentially becomes a stock that takes off. 8.6 million shares. If I add the relative volume for the day, let's see.
Market with its user friendly and affordable design today announced a successful launch of
Okay, not big, but you're looking at the relative volume. You want something that's maybe 2 to 3 times its normal average of volume, showing that the news is significant. It's driving it up higher today, or whatever the segment momentum may be. it's trading more volume today than it was trading over the course of the past week because it's showing something is it's implying that something is causing that momentum, whether it's the upside or the downside. That's in perspective of the direction of the actual trade. So, yeah, whether it's good news or bad news, whether it's insider trading or whatever the case may be, something that they know that we don't know, it's causing it to run, who knows, whatever it is, it's causing more volume today than it has previously shown average wise. The current volume is trading higher than the average volume. That's all that relative value of volume means. And that's key. But as I stated earlier, my watch list is set up to find trades that trade above pre-market highs. We don't care about post-market because there may have been some type of exaggerated move the night before because people tend to sleep on things and find logic behind their position size and reposition themselves, whether good or bad. So you want pre-market because now you have new eyes on the news because some people may have missed the news. Some people may have woke up to profits and then been able
Stretching
to
this
take
leg.
profits
Uh-oh,
whether
did you
it's,
hear me, bro?
whether things are down, whether it's somebody intending to add more to their bag, or people are letting go of position sizes in their bag. But this wick here, see this skinny little line, this wick has traders trapped that purchased when the stock rose all the way up here. So we are anticipating a move back up to the top of this wick as traders that have been trapped that purchase at those levels attempt to seek profit throughout the day or better their positions or finally break even. So we purchased at the highs down here at these levels, a little bit above them. We're trapped in the wick, but we're just at the top of the highs before there was a reversal, which pushed back down to these areas, and then it bounced off those areas. At any point in time, I could take profit for $2, but where's the fun in that? We could seek a potential $20 profit with a 255 share size. We just need some parabolic move. So we may get a retest of these previous highs of the day, or we may get a continuation back up to the top of these wicks. Or we may trade sideways. Stocks do three things. It either goes up, down, or trade sideways. Can't do anything else. The trade sideways is just because the prices stayed stagnant and it just lingered throughout the day. And each candlestick closed at the same price that the next price opened at in continuation throughout the rest of the trading day. You'd really only see that when you have stocks that have reported that the company has been bought out at a certain price, and that price just sits all day because nobody's trading it. because there's some type of paperwork going on the back end where the stock has been halted or suspended from trading, and they are looking to properly complete paperwork of ownership of new shares and new prices and things of that nature. Or the volume may be that low that the prices are trapped at a certain block of shares attempting to be bought and a certain amount of shares attempting to be sold. So support and resistance keeps it stagnant throughout that day. We were down as much as about $15, $16 for this trade, for this position. So at that point, we really don't have any real risk involved in the downside. If it pushes back down, we don't care because we've already seen losses of $16 on this stock, only to push up and see a profit of $5 so far. So we want to see something move up to about 120 before we start considering a sale. We may not see that because volume is kind of becoming stagnant. As you can see with the MACD, it's just moving sideways. So the average prices are stagnant. It's not being bought or sold. It's just sitting there. They're battling for the upside and the downside. But just to say that this position was closed in profit, we can just close it and say, hey, we took a $3 gain for this position, but that'll be a negative profit to loss ratio that we want to see. They tell you want to see like a 2-to-1 profit to risk or reward to risk type of ratio. So if I potentially lost 15, I want to potentially make $30 on this trade, which may not be realistic because my risk management should have been better than that. $15 loss should have been cut to maybe a $6-7 loss, so I could see a $12 reward. But we are not following those metrics because I opened about 9 positions at once. And out of those 9 positions, I was profitable maybe more than half of those positions. I took the green.
Get our trigger finger ready.
Half I took the reds, took losses on. And I cut those trades because they fell below pre-market highs. Let me see what BTCS is doing now. It's pushing back up. Retesting pre-market highs. Some of them a bitch. But man, I sold at about like 7:30 or something. We don't care. We don't care. Now they are trying to push it back down. If I close, I'm just going to break even, but who cares? Where's the fun in that? I'm about to start playing my game again. I don't have time to watch this shit. And that's why you take positions that aren't meaningful. If it's a loser, it doesn't crush your account. It's about a $283 position size, so whatever. We're not really hurt or takes away the emotion behind the trade. It allows you to say maybe I can turn this into a day trade or a swing trade or something. Who cares? I can break even right now at 110, but why? Well, we sold off and pushed back up to new high of days.
Drop that over
Well, this
shit
hasn't hit
for
the high
like
of day. High of day of this is about 124.
15 minutes.
So
Or less.
let's see how it plays out. Then we have a down day in the market. Dow Jones is down 165 points. S&P down 0.28. Just went positive zero point 0.4. Nasdaq is up 11 points. It's not a very bullish day, but to have a portfolio that is just breaking even for the day, that's rewarding. To know that you just beat the market by a marginal fraction of an amount. So we thought that once it broke above previous highs that the market closed that it would have taken off and continued a parabolic move, but hasn't done so. Hasn't done so. The professional trader, I mean, would close at break even just to say, hey, this trade was broken even after being down $16. You take that break even amount and be comfortable with that. And as I'm talking about it, look at the way that the market is reacting. So this 15-minute candlestick is now falling below the previous 15-minute candlestick, showing that it wants to pull back. It's losing momentum. It's lost all momentum. It lingered at that 112, 111 range. And now the buyers have dried up. And even looking at the MACD is now light green. So we're just going to close it at this point. Who cares? $7. We don't care. It's nothing significant. So my only mistake was closing certain positions too late. So such as this, when this red candlestick closed below this bigger bullish candlestick, once it closed below it, I should have closed out. But because I was watching so many candles at once, so many different tickers, it didn't allow for proper risk management. So that's something that you become conscious of and aware of to allow for proper risk management. When you get a 15-minute candlestick pulling back, it's going to show signs that momentum has been lost. Get out. Because you don't want to play the game of trying to determine if something is going to continue its bounce up. This right here was an engulfing candlestick. If I took this entire candle and put it beside this, it will be larger than this entire body of this candle, including the wick by itself. So it showed that the bulls had lost and the bears had took over. So at this point I should have closed out at this 779 instead of closing down at about 730 something. That would have turned the $19 loss into about a $7 or $8 loss. Let's see what else I traded. This UABS. I closed this at about 195. back above previous pre-market highs. Let's see. Just for the hell of it, we're open for shares. Who cares? It's about $8. Who cares? $12. Got about six of them. 7 shares. This is the first continuation above pre-market highs. See if they can break back above these higher days, back up to this 253 mark. But my previous position average was about 205, 206. So I would have been back in the green, but who cares? Just nothing that we're gonna kick ourselves over. Split line position was a mistake that I did not intend to open because it never opened above, it never closed above previous pre-market highs. I should not have been in that position to begin with. CIG, I closed at about 108. We were testing this previous high of days. We're not in that position anymore. WGRX, we closed up here at about 156. This wick was so significant that we needed to get out. TGN, we got out at about 718. TDTH. Let's see what my history was for that. Did I trade that about? Yeah, I closed that at about 156. I bought in at about 130. Still a long day of trading to continue to go. IXHL, close this out, like I said, at about 52. So right where we're at, 52.89, 80. ETOG, let's see what that is doing. I removed that from my watch list to keep me from getting suckered into that move. I
time frames and the trends and content
here,
that
and I sold that one at about 594
six
out here.
tickers that are 100%
That sold off to a 570. Now it's back at about
5
608.
and 6 at the same time. But yet,
606.
sold on these highs. So, and so tickers doing
There's
600%.
GRX. I bought it 137.
So, a couple of tickers is Monday, Tuesday, did 5,000, 3,000%.
Sold at 168.
It's cool. Pulled back a few grand.
So bought that about down here. This went sold off to 108. I sold up here at 160. Wait, what did I say? GRX. I sold 168, so I sold at the top of this wick. So TGN 750. The spread is significant. 20 cents. So sellers are selling at 747. Buyers are trying to buy at 727. You don't want to get caught up in any moves like that, because if you buy from the seller, you're going to immediately sell for a 20-cent loss. You don't want that.
My average at the time was 721. Which was anything crazy. I just got out because I was tired of watching it. But that's here nor there. So all in all, I traded 1, 2, 3, 4, 5, 6, 7, 8, 9 different 10 different tickers today for no reason, just trading them. So I'm gonna conclude this live stream and I'll get back with you guys later. Alright, you guys have a good day.
At Granger, we're for the ones who pay attention to every little detail, the ones who fuss, tinker, and sweat the small stuff. Because you know the tiniest thing can make the biggest difference when it comes to keeping business moving. We get it. We're the same way, offering access to product experts to help you quickly and easily find what you need. So whatever your industry, you know you're always getting professional-grade products. Call, click Granger.com, or just stop by. Granger, for the ones who get it done.
On a Thursday in the middle of 2010, a man named Navinder Sarao was trading stocks from a bedroom in his mother's West London home. His laptop was connected to the American financial markets, which were experiencing higher than normal levels of volatility.
All right, you're looking at what's going on in Greece right now. In the U.S. markets, financials causing another leg down.
The large minute-by-minute swings created fertile grounds for huge trading profits, and by 7:40 p.m. he logged off for the day, raking in nearly $1 million in profits. All the way over in New York, the local time was 2:40 p.m. A bad day for the market so far, but still just a couple of percentage points down from when trading started that morning. But just 60 seconds after Navinder logged off for the day, all hell broke loose.
We have not seen a day like this.
What the heck is going on down here? I don't know.
I'm looking at Eurodollar futures. We're down 13.5 basis points.
Down nearly 900.
I mean, there is fear. This is capitulation, really.
Within 4 minutes, the stock market was down almost 10%, $1 trillion of value wiped off American companies in minutes. The day became known as the flash crash of 2010, one of the most violent and unexpected collapses in stock market history. A crash that exposed the dark side of a new wave of algorithmic trading, ushered in sweeping financial regulations, and revealed a fascinating story of a lone UK bedroom trader who abused loopholes to make tens of millions of dollars. So, what exactly happened? It was the 6th of May 2010, and when trading opened at 9:30 Eastern Time, it was immediately an unusual day. New information regarding the European debt crisis had come to light overnight, and traders were responding to it. There's an index called the VIX, which tracks market volatility, how violently stocks are changing in price. It's also referred to as the Fear Index, and by 2:30 p.m. it was up 22.5%, indicating that this was already a very turbulent day for the markets. The S&P 500 index, which tracks the US stock market, was down a couple of percent. Then at 2:32 p.m, something really unexpected happened. A huge block of E-mini S&P 500 futures was dumped on the market. These are a type of financial contract that traders use to bet on the movement of the stock market. Don't worry, the details aren't that important yet. But someone suddenly throws 75,000 of these contracts at the market, a total value of $4.1 billion. It's a huge shock to the system, and just 9 minutes later, stocks plunged 3% in a matter of minutes. By 2:45, the market was down nearly 10% on the day. At the individual stock level, things are even more chaotic. 2 billion shares are traded between 2:40 and 3 p.m, a total volume of $56 billion. About 20,000 trades are executed at prices more than 60% above or below where they were trading just a few minutes earlier, some at completely irrational prices. ACN, the stock representing Accenture, fell from $40 a share to 1 cent within 7 seconds. A $30 billion company was suddenly trading for under $10 million. Other stocks saw the equally irrational opposing situation. Apple stock went from $250 a share to $100,000 a share within seconds, briefly valuing the company at $54 trillion, which is almost the total value of the entire US stock market today. I really want to highlight just how absurd this is. There were 2 trades for 895 Apple shares executed at these prices. In total, they should have sold for $216,000, but instead they sold for $89.5 million. And then it just stopped. By 3 p.m, the broad stock market had largely regained its losses from the crash, although still down as it was when the day began. The crash lasted just 36 minutes, hence the name Flash Crash, and the violent financial event naturally raised a lot of questions. Questions which we now have the answers to. What caused the crash? Who were the traders responsible? And what does all of this have to do with a British man who discovered a hack to make millions from his bedroom?
From Geico Subconscious News, I'm Tammy Racing Thoughts, broadcasting from your brain. You think you live in a pretty safe place, but you just heard about a break-in 4 miles away, which isn't close, but it isn't far either, you know? Art Palpitations is on the scene.
I sure am, Tammy, and I don't even know why I drove out here, because as you know, you got customized renter's insurance through Geico, so your stuff is covered.
Oh, well that's great. Any sign of crime there, Art?
Just some light littering, Tammy, but like they say, a little litter can lead to a lot.
Wise words. Worry less and get more with Geico.
So, who is Navinder Sarao? He was born in 1978 into a typical British working class family, and his first big introduction to the world of trading was through a job at Futex Live in the mid-2000s. It was there he learned how to trade stocks, and he was really good at it. He mostly traded futures contracts. They are legal agreements to buy or sell an asset at a specific price and date in the future. So instead of just buying SPY, the index that represents the US stock market, I could buy futures contracts to bet on the change in price. For the US stock market, this is called the E-mini S&P 500 futures. I only have to put up a small collateral for each one, and each contract allows me to control 50 shares of the index. So I can make or lose a lot of money from small upward or downward movements. Navinder found success in trading these E-mini S&P 500 contracts, and by the time he left Futex Live in 2008, he'd accumulated about $2 million. When he left the firm, it was the middle of the global financial crisis. He believed that a bailout for financial institutions was coming, so he bet all of his money on stocks rebounding. The week that the bailouts were announced, the stock market increased 19%, and using futures contracts, he turned his $2 million into $15 million. He continued to trade during 2009, but he noticed it was becoming harder to make profits because of a new type of trading: high-frequency trading. With computers and the internet becoming much more sophisticated, automated trading was growing in use. A New York Times article from July 2009 was one of the first times it gained mainstream attention. They described high-frequency trading. Powerful algorithms execute millions of orders a second and scan dozens of public and private marketplaces simultaneously. They can spot trends before other investors can blink, changing orders and strategies within milliseconds. There are many strategies that high-frequency traders use to profit, but I'll just explain a couple of them. Stock exchanges like the New York Stock Exchange and the Nasdaq are supposed to show all of the available buy and sell orders to everyone at the same time, but they used a loophole to show some traders orders ahead of time in exchange for a fee. So slow traders place their buy orders, but rather than being shown all of the potential sellers at the same time, some of those orders were most likely routed to a collection of high-frequency traders for just 30 milliseconds in what is known as a flash order. Yep, that's right, they called them flash orders, possibly the biggest foreshadowing of all time. By receiving orders from the exchange a few milliseconds before everyone else, high-frequency trading bots can quickly buy and sell shares for a tiny profit. High-frequency traders also benefit from competition among the various exchanges, which pay small fees that are often collected by the biggest and most active traders, typically a quarter of a cent per share to whoever arrives first. But then the article talks about another strategy, which in hindsight was essentially a blueprint for anyone who wanted to abuse financial markets for a profit. They analyzed a July 15th trading session. Chipmaker Intel had reported strong quarterly earnings the night before, and traders set out to buy another chipmaker, Broadcom, when the market opened. Beyond the genuine trades, there was a lot of stock manipulation. Soon, thousands of orders began flooding the markets as high-frequency software went into high gear. Automatic programs began issuing and cancelling tiny orders within milliseconds to determine how much the slower traders were willing to pay. The high-frequency computers quickly determined that some investors' upper limit was $26.40. The price shot to $26.39, and high-frequency programs began offering to sell hundreds of thousands of shares. Creating and quickly cancelling orders is a type of market manipulation. It was already illegal at the time, but it didn't have a specific definition in US law. It became known as spoofing because it involved making fake orders for the sole intention of tricking other traders into thinking that a stock had more interested buyers than it actually had. Navinder Sarao, who was frustrated with high-frequency traders stealing his profits, began using this illegal strategy.
One invoice? Easy. Hundreds of invoices? Yikes. Unless you use FreshBooks. With automated invoicing and payments, your billing is handled with just a few clicks. No chaos, just smooth, stress-free growth. Keep growing with FreshBooks. Start free today at freshbooks.com.
He built his own custom high-frequency trading bot and started trading E-mini S&P futures again. But this time, he used his bot to create thousands of fake orders before quickly cancelling them. The spoofed orders were set at all different prices to give the appearance that these were genuine trades from different traders. This specifically is called layering, another very illegal form of market manipulation. The fake market activity created a momentum in the price that he could then profit from with genuine trades. And it worked wonders. He was making hundreds of thousands of dollars a day. Which brings us back to the infamous flash crash on May 6, 2010. Navinder was trading the markets from a bedroom in his parents' home. He used his spoofing and layering strategy to profit from the increased volatility. By midday, he was placing around $200 million worth of trades, and by 2:40 p.m. ET, or 7:40 p.m. in his local time, he logged off after making $950,000. A minute later, the flash crash began. So did Navinder cause the flash crash with his huge volume of fake trades? Well, not exactly. The Financial Times reported that Navinder's fake trades were so large they made up 20% of all the sell orders of the E-mini S&P futures at various times during the day, which in simple terms means he did add a lot of trading volume to the market, and he did push prices to artificially low and high prices so that he could profit from them. But he wasn't actually trading when the crash occurred. An official report later found that while he and other high-frequency traders did contribute to the crash, there was someone else who actually caused it. Well, actually, I looked at a number of different reports that all analyzed the trading data. The two main pieces were a study published in 2014 and the official report from the SEC and CFTC. Notably, this report makes no mention of Navinder's illegal trading activity. And that was by design. Navinder was already under investigation by the Department of Justice, and they didn't want to alert him. But I'll get back to this later in the video. The most shocking part of the flash crash is that the entire crash can pretty much be traced back to a single trade. At 2:32 p.m, a mutual fund initiated an order to sell 75,000 E-mini S&P futures contracts, a total value of $4.1 billion. Now, you can't just dump an order like this on the market without crashing the price, because there wouldn't be enough buyers on the other side. The buy-side liquidity for the E-mini contracts was under $3 billion. Buy-side liquidity effectively meaning the pool of willing buyers. And so this trade would have to be slowly drip-fed into the market. For reference, a similar trade to this earlier in the year took more than 5 hours to fully execute. So the mutual fund decided to use a sell algorithm to slowly sell the 75,000 contracts. They set the target execution rate at 9% of the trading volume from the previous minute. This limit prevents the bot from dumping too many shares onto the market too quickly. If there was $1 billion of these contracts being traded back and forth every minute, the bot would only sell $90 million worth of contracts every minute. Sell algorithms can also have price and timing limits so that the contracts aren't sold on the market for a price that's too low. This mutual fund used no such limits. Any price and any speed was acceptable as long as it didn't exceed 9% of trading volume. And that was a huge mistake. On initial thought, you might think that trading volume is a good way to see or measure how many willing buyers there are for these E-mini contracts. After all, if the trading volume is $1 billion has been traded back and forth over the past minute, doesn't that mean that there's, at least in the last minute, a willingness of people to buy $1 billion worth of contracts? This logic was pretty much true for the entire history of the stock market. Except in 2010, there's another huge element. High-frequency traders. Remember, these trading bots aren't trying to acquire or offload their own positions. They're buying and selling just milliseconds apart, often to other bots, before the real buyer acquires the contract. They don't add to the pool of willing buyers, but they do increase the volume. Between 2:41 and 2:44 p.m, high-frequency traders traded 140,000 E-mini contracts, representing 33% of total volume. Bots that had no intention of holding the contracts were driving up the trading volume. As the volume rose, the mutual fund's sell algorithm viewed this as the pool of willing buyers increasing, so it started feeding more of the 75,000 contracts into the market. The high-frequency traders were creating the illusion that there was lots of willing buyers, and when there weren't enough buyers, it crashed the E-mini market. The pain quickly spread into the actual stock market because of cross-market arbitrages. These are traders who buy the E-mini contracts and sell the SPY index to profit from small discrepancies between those two prices. But in this case, they essentially were transferring the collapsing E-mini market into the actual stock market. Within just 20 minutes, the entire 75,000 contract order had been executed on the market, an order that should have taken more than 5 hours. This 2014 study specifically looked at the role of high-frequency traders. It concluded that while they did increase the trading volume, they didn't actually cause the crash. They just accelerated a problem that was essentially created by the mutual fund that made a huge oopsie when it came to the sell algorithm of those 75,000 contracts. Navinder was one of these high-frequency traders who were not directly to blame, but did add fuel to the fire. Of course, one big difference was that most of Navinder's trades were completely fraudulent, and it didn't go unnoticed. Sometime shortly after, the Commodities Futures Trading Commission received information about some strange groups of trading orders that were made during the crash.
The data sets that we reviewed for Now's activity showed he would place these orders together and modify those orders several, sometimes thousands of times or hundreds of times before then canceling them and not getting hit.
Welcome to a moment of calmness from One A Day. Wait. Don't zone out yet. One A Day multivitamins help provide nutritional support for your well-being as part of a healthy lifestyle. So whether you're navigating a busy day or seeking quiet reflection, One A Day vitamins are here for you. Choose clarity, choose wellness. Choose One A Day multivitamins. Science that matters for nutritional support. Grab your One A Day vitamins at your favorite retailer today.
With enough evidence, the CFTC passes the case over to the Department of Justice. The investigation took years to complete, but in 2015, Navinder was finally arrested in the UK. He was indicted by a grand jury on 22 counts of wire fraud, commodities fraud, and manipulation for trades between 2009 and 2014. The 22 charges carried a maximum sentence of 380 years in prison. The Financial Times reported that Navinder admitted to entering more than 85 spoof trades on the day of the crash. And in the DOJ statement, it says he admitted to making at least $12.8 million from the illegal activities. In 2016, he entered a plea agreement with the DOJ on spoofing and wire fraud charges. But thanks to his help in furthering US financial regulations, he only received 1 year's house arrest. The flash crash brought with it a tightening of financial regulations. The Dodd-Frank Wall Street Act was passed as law just 2 weeks after the crash. It was a piece of legislation initiated by President Obama after the global financial crisis. And among other things, it finally provided a direct definition of spoofing in US law. The crash also shed light on a number of flaws in financial markets. How large automated sell orders can trigger extreme price movements. That high trading volume is not always a reliable indicator of market liquidity. And another example of just how connected the derivatives and securities markets are. After Navinder's arrest, many believed he was essentially a scapegoat for a practice that was rampant on Wall Street. Spoofing and layering trades should be illegal, but it's also something done all the time, even by the big firms. Going after a lone UK trader for this is even more ridiculous when you consider the global financial crisis just happened, and only one person was jailed in the US for their role in the crisis. I hope you guys enjoyed this very long and complicated story, and if you did, a huge way that you can support me is simply by hitting the subscribe button. And even better, check out one of my other videos next.
15 minutes of chaos that shook the world's biggest market.
What the heck is going on down here? I don't know. There is fear. This is capitulation, really.
On May 6, 2010, without warning, the US stock market and futures markets just crashed.
Can't be there. That is not a real price.
The flash crash, which wiped $1 trillion off the value of American companies in 5 minutes.
To look at a price chart, it looked like a kind of runaway elevator.
It took authorities 5 years, guys, to track down this lone British trader allegedly involved in a 2010 flash crash.
Navinder Singh Sarot, dubbed the Hound of Hounslow, has been accused of manipulating the market.
US regulators claim he made about $40 million.
So Navinder Sarot, he seems to be, to all intents and purposes, like a sort of arch criminal mastermind. What they find is very different.
We're in a working class neighborhood about 11 miles from the city center in the financial district.
It was hard to believe somebody trading this size was just a lone trader, but that's where we were.
I think it's ridiculous to say that this guy in this house in the suburbs in England
took down the market?
It's ridiculous.
You know, if you really did, as the U.S. prosecutors allege, make $40 million, 3 people have now said to me, well, then why the heck is he still living on our street?
On the one hand, he was a kind of common cheat.
He purposefully manipulated the markets.
On the other hand, he's this kind of genius kid from the wrong side of the tracks. He just decided to almost stick two fingers up at the man and the establishment. And I think everyone can kind of relate to wanting to do that. I'm Liam Vaughan. I'm an investigative journalist with Bloomberg in London, and I'm the author of a book called Flash Crash, which tells the story of the 2010 flash crash and Navinder Singh Sarao, the British day trader who was accused by the US government of causing it from his bedroom. So Navinder Sarao was, in a lot of ways, quite an ordinary kid from a working class neighbourhood underneath the Heathrow flight path. Had a bit of a gob on him, was always very kind of fast and quick-witted, but also a little bit quick to kind of anger. He had this gift for multiplication and for rapid thinking and for arithmetic. After university, he opens a newspaper, and it's the Evening Standard, and there's an advert in there which says, "Wanted futures traders must work well under pressure," which, as you can imagine, is not how they typically recruit, staff at JP Morgan. But this was a job at these kind of fledgling entities that were known as arcades at that point in time.
All the learning takes place on the trading floor among some of the best traders in Europe.
Essentially, you eat what you kill. And that's something really powerful when you're seeking a career where you make your decisions and profit on those decisions on a daily basis.
So Futex is above a Waitrose supermarket. It's about 45 minutes outside of the city of London, miles away from the skyscrapers of the city and Canary Wharf. And at first it's a fairly shabby office, which has got connections to the world's commodities exchanges. Now, Nav had this kind of background in computer games. He was incredibly focused and gifted at games like Halo and FIFA. And he was able, he found, to sit for hours and hours at a time, just focusing on one task until he'd mastered it. Fast forward, a couple of years, and Navinder is almost like a kind of enigmatic figure at Futex. He has decided that he can't stand the disruption of his colleagues chatting amongst themselves, getting very excited with market moves. So he moves himself to a desk completely isolated where he can work on his own. He buys himself a pair of ear defenders. They're not headphones, they're literally ear defenders of the type that road workers use. To the other traders there, lots of them, wannabe traders, he was almost like a godlike figure because they would see how much money he was making, the size of the trades that he was placing, and it was just a complete mystery to them how he was able to do it. So Nav traded a financial instrument called the E-mini, which essentially tracks the S&P 500, which is a barometer essentially of the US stock market. And he's able to build a sense based on his constant reading of the market and his almost preternatural ability to determine whether he thinks the market's about to go up or down based on what's happening and the orders that are entering and leaving the market. Nav leaves Futex in 2008 in the midst of the global financial crisis.
The banking sector bore the brunt of the collapse, with shares in Europe's major banks tanking by as much as 9%.
By that stage, he's in his late 20s, and he's already accumulated about $2 million. Lehman Brothers has just collapsed.
I don't think anyone really expected a bank as big as Lehman to, be in a position that it's in now.
The entire global financial system is, in danger.
We are in the midst of a serious financial crisis, and the federal government is responding with decisive action.
There's governments around the world stepping in to save financial institutions, and this is Nav's, first very big and successful trade, almost career-defining trade. He decides that with market prices as low as they are, eventually the government is going to have to step in and rescue them. So he places all of his money, which at that stage is a couple of $1 million.
When too much work bogs you down, Asana helps you handle it. That's because Asana is where humans and AI coordinate work together. AI makes it easy to hand off routine tasks, streamline workflows, and keep everyone focused on the work that matters most. That's how work gets handled. That's Asana. Visit us at asana.com. That's ASANA.com.
On this bet that the government's going to intervene and prices will rise again. And he times it absolutely perfectly. He places a trade on a Friday. The following Monday, the US government announces this big bazooka.
Under our proposal, the federal government would put up to $700 billion taxpayer dollars on the line to purchase troubled assets that are clogging the financial system.
And over the course of that week, US prices increased by 19%. NAV had ridden the wave, the entire wave, and he goes from a position of $2 million to suddenly being worth $15 million. And really, that's when he hits the big time.
I'm trying to stack up my paper. That shit will f a hater. The only time when they holler is when they need you for favors. See you, these haters are minor, cause this big shit is major. I'll be rocking designers and still designing my trainers.
One of the striking things about Navinder is that he really doesn't spend any of the money he makes at all. He kind of makes a decision early on that he doesn't want to tell his friends and family about the money. He doesn't want to be seen as a show-off, and he doesn't want them to treat him differently. So rather than actually spending the money or telling other people about it, he just keeps it to himself and he lets the dollars grow in his profit and loss account.
I was in the back with the bailers. You was doing fake with the favors. You was getting run down by the dippers. We were the ones with the tapers. You can't go to the ends. Me, I'm there in my slippers.
You would have thought that Nav would be delighted at the money that he's made and his position and how successful he is, but there's something that's frustrating and bugging him, and that is the arrival in the markets of this kind of new breed of participant that are known as high-frequency traders.
What is high-frequency trading?
Well, high-frequency trading is where the markets have evolved to. So people have written rules that would normally be executed in a human being's brain into the computer, and they trade at very high frequencies because high speeds because the computers and the communications lines allow them to.
They buy stocks just before other people do and then resell them at a small increase, pocketing the tiny profit.
So what's happening is a kind of skim. People are getting scalped in the market.
Well, for Nav, he wasn't so interested in the kind of equality of the markets. He was more frustrated that his profits and his ability to kind of make money was getting squashed by these robots.
We have executed 21 million shares already.
Wow, and we are not even 3 minutes in.
So in 2009, 2010, he makes this kind of fateful decision that he's going to build his own robot that's going to fight back against the HFT firms. And what he was planning to do was to essentially manipulate the market. And after a few, I guess, teething problems, it starts to work incredibly well. From his bedroom, he's able to routinely nudge the world's second largest futures market. He could quite easily make $500,000 in a day. In the week before the flash crash, on one day he made $400,000. The next day he made $800,000. And if you can imagine, he lives in Hounslow. His parents' house is worth, $300,000, and he's making 3 times that amount every single day.
Welcome to Street Signs on this Thursday afternoon. A big afternoon as stocks accelerate their slide.
May 6, 2010 is an extremely volatile day.
There is a feeling that the European Central Bank and bankers have lost control of the situation.
There's this index known as the fear index in financial markets, which kind of monitors volatility. And that thing is up 30%.
to basically just like the machine. You guys, right.